Welcome everyone. Thank you so much for joining us for our regular free Thursday webinar today. I'm Nikki Jovicic from Lookupstrata, and I'm also the Managing Director of Tower Body Corporate, and I'm your host today. Building a successful strata management business is a significant achievement. It requires years of dedication, expertise, and strategic planning. But have you ever stopped to consider the true value of your business? Whether you're contemplating selling or simply curious about your business's worth, this webinar is designed to provide you with interesting insights about understanding the market, knowing the key drivers of value, and implementing strategic growth initiatives to maximise return on your investment. So I'm very happy to introduce David Lynn from Strata Business Brokers. David's here to help you navigate the complexities of the strata management business sale process. Before we begin, I'd like to mention that the information in the session, including the discussions arising from submitted questions and chat conversations, is not legal or financial advice and should not be relied upon as advice. You should seek independent advice before acting on the information contained in this session. We welcome David Lynn. David established Strata Business Brokers in 2019, and he's worked in the strata industry for the past 12 years, complemented by a strong financial background in external audits and banking. And David's professional experience includes roles at Ernst & Young, Goldman Sachs, and CBA. So thank you very much for joining us today, David, for this interesting session.
Thank you, Nikki. Good morning, everyone. Strata business owners, given I think we've got a national audience, I thought I would start by taking a national view and just talking about how the states in Australia compare. I think if you were to go back 20 years, I think there was probably a little bit of an imbalance across the states with the strata valuations. I think 20 years ago, you could have gone to Perth, you could have gone to Hobart and bought a strata portfolio at a much lower value than what it's worth today. So if you had done that, bought a portfolio in Perth in the strata space 20 years ago, everything else remaining constant, the valuation would have risen over time. So what I'm really saying is, from a national view, in terms of current state, there's definitely a parity in terms of valuations. So, in terms of, some of the things we're talking about today, I think they do apply nationally for the most part, and by which I mean the capital cities at the very least across the country. So today we're hopefully going to try and uncover and answer these two questions. What is your strata business worth? And how do you actually value your business? And why would you want to know the value of your business? It's not necessarily just because you're going to want to sell it next week, but there's definitely a whole host of other really good reasons for you to know the value of your business. I think the first thing is you want to maybe use the business assets to obtain funding. So that might involve business expansion, hiring, growth, and acquisition. But definitely in terms of being in the strata industry, where it's very robust, when you have a strata portfolio, there's a value there, and using that value to leverage funding is a really good way to inject funds into your business. The other reason you might want to know the value of your business is for equity buy-ins and buyouts. So I had a lengthy conversation last week with a gentleman out of Sydney. He was looking to retire and his business partner was going to buy him out. So the question then arose, what was the value of his share in that business? The other reason why you might want to know the value would be for strategic realignment of your OC or strata book. So downsizing to free up resources, so OC management or strata management capacity, and also funding capacity. There's definitely been a few companies in Sydney and in Melbourne in recent years who have looked at the business and said, okay, there's a portfolio or pool of clients that maybe are not as vital to the business as they once were. So typically the clients might be smaller, they might be further away geographically from where their office and client base is located. So that strategic realignment, I think, has a lot of merits and lots of value to a lot of businesses if the business owners take the time, sit down, take a step back and reassess their clients and look at what's sort of fundamental and core to the business and what maybe is even slowing the business down in terms of clients. The other reason that you might want to know the value of your business is the hit by the proverbial bus. there's definitely been a few business owners that we've known over the years who unexpectedly have run into health issues. So that might result in them having to bring in external staff in to run the business, or it might result in a conversation where they're ready to make an exit. So really knowing the value of your business is important from that perspective, because none of us has a crystal ball to foresee what might or may not happen. The other reason you might want to know the value of your business is the times come to exit or retire. And it's a really good idea when we're sort of a few years away from that time frame to have a plan, a strategy in mind, rather than leaving it to the last minute. So I think, knowing the value isn't just about wanting to sell and exit next week. It's for a whole host of reasons that it's really, really important to know. The other thing I might touch on is, this is from the Macquarie benchmarking report, and that's a national view in terms of the size of businesses within Australia in the strata industry. And you can see there's a few different pockets of concentration in terms of sizes of businesses. And that's important to know because it leads right into our next topic and question. When you do come to sell, what is the transaction or the type of sale that you're undertaking? Because I think the concerning thing that's sort of come to my attention in recent months is we've been having a lot of conversations with different business owners who are going through this sales process, but the broker doesn't actually know that what the actual transaction is. There's a few different ways you can sell your business in terms of whether you're doing an asset sale, an equity sale. Depending on how that is structured, it can make quite a difference to you as a business owner from a taxation, legal perspective. And the implication or the difference in your pocket, if you get it wrong, can be either hundreds of thousands of dollars, if not more, depending on the size of transaction, depending on your particular tax situation. So I think that's a really important area and a really important question to know. The other point I want to make today is, does the bank valuation or the bank funding limits equal the business sale valuation? And the answer is probably not. The reason being, I think, banks, when they're giving you a valuation on your business, they're looking at it from a credit risk funding perspective. So I think this is a useful diagram because there's a component where your true business value sits within a certain range. There's a selling price, and then there's a bank value, and they're not always necessarily the one and the same. So I think it's important to understand that there could be differences, and we'll touch on why these are different in a second. Because once again, we've had conversations where the business partner is buying out the other business partner. And if the foundation of the transaction or the buyout is just simply because the bank said, we'll fund X, that doesn't necessarily equate to the true business value. So what are the actual value drivers in your strata business? Obviously, we can put it into two categories: the quantitative, and absolutely that's very important in terms of, we're talking about lots under management, buildings under management, revenue per lot, total revenue, total expenses. So obviously the quantitative is important, but I think any sophisticated acquirer in this space or any space is always going to be looking at the qualitative components of your business. How does the qualitative factors come in throughout these transactions when a potential acquirer is looking at your business? I think the best analogy would be if they were looking at your business and marking your homework, or rather giving you a report card. So there will be different areas that they will go through and they will attribute a rating, more or less, in their minds. So things like the coherence of the client base, are they all sort of similar in size, location, type? Or are they all scattered around? Things like, I've heard companies moving their finance operations offshore. Is that going to be a red mark into a potential acquirer? And obviously it differs between the states. So New South Wales is a lot more prescriptive and has a lot higher bar in terms of the owners corporation or strata client accounts and the funds. So I think these are the things that you have to consider in terms of the business, qualitative factors. The other one that we've seen is businesses using their own software. Now, is that going to be a attractive feature or an unattractive feature for your business? Because as an acquirer, if it's a software they're not familiar with, they're going to want to know how difficult it is to migrate that information and the OC records across to their platform. So there's some of the qualitative factors, and it's a pretty long list. We haven't got time today to go into it all, but I think quantitative, but also look at the qualitative aspects of your business. The other area that I'm really passionate about, because of all the conversations I've been having in recent months and years, is that as an industry, there's an obsession with talking about multipliers, and what a multiplier really is a top line rule of thumb or yardstick. Now, did it work probably 20, 30 years ago? Absolutely. The reason being 20, 30 years ago, if you looked at all the capital cities, the concentration of high rises and the average lot sizes of buildings isn't what it is today. All those high rises and all those developments have really only occurred in the last 20, 30 years. So something that worked 20, 30 years ago definitely doesn't work today for a number of reasons. So 30 years ago, the industry, when you had a lot of the elder statesmen running this industry, I think there was a lot smaller number of operators. The business models were more or less the same. The revenue models were more or less the same. Now, in the course of 20, 30 years, there's been a divergence of building types. There's been a divergence of revenue models and business models. And in terms of entrants, there's a lot of new entrants. And in terms of fee structures, it's very different today than what it is today. So how can you apply a top line multiplier when you have one business over here where out of every dollar of revenue, 50% is the management fee, and then you have a business over here where $1 of every revenue is the management fee, because the software, the disbursements is included, and this business doesn't take any insurance commissions. So you see how quickly this methodology falls apart. So I think that's something that's a bit of a hangover in terms of multipliers and talking about top line valuation methodologies. It's simplistic, and it doesn't apply to today's strata market. And it doesn't matter whether you're in Sydney, it doesn't matter whether you're in Queensland or Melbourne. The models have varied so much, and what worked 20, 30 years ago definitely doesn't work today. So that's a really, I think, dangerous fallacy when, brokers or business owners are throwing these numbers around that apply a top end or top line multiplier to a component of your revenue, which may or may not be 50% or 100%. And we've written actually an article on that, and I've provided the link there. But that's something I really wanted to get across and communicate today. So in terms of a general overview of a sale process, I think, there's probably only 5 components if we take a high level view. Firstly, as a business owner, you make the resolution, and everyone's in Strata, so you know what a resolution is. You've got to make the resolution that it's the right thing to do and the right time to do it. The second component, or that's important, is to get your house in order, and we'll touch on that in a little bit later. The third component, I would say, is to speak to a broker. Unless you've got a friend that wants to buy the business. The fourth component, I would say, it's keeping things confidential. It's a pretty small industry. Information gets out and travels fast. And there's various reasons why you wouldn't want to disclose or have it be known that you're looking at selling, whether it's clients, employees, competitors, whatever the case might be. And the fifth component, I would say, is to get the experts lined up. By experts, I mean, it's a pretty big process in terms of steps involved, the work that goes in, and in terms of the significance of this process to you. And you want to get it right. And we've seen a few business owners get it wrong. They've had a cheap broker. They've had the buyer who was willing to pay 30, 40% more than it was worth. They've had the contract put together, and then the purchasers pulled out at the last minute. And presumably the reason was because the bank or the funding party said, look, the valuation isn't right. So they've pulled out. And the business owners has been left with a $30,000 bill on legals because of all the contract revisions and all the other back and forth. So that's a really bad outcome, and it's a lot of wasted time and opportunity. And I think, when you're spending that much on a failed settlement, something's not right. So these are really important parties to be mindful of and to get right. And there's one component that's on the vendor side, and there's one component on the acquirer side. Okay. The other emphasis I want to cover off today is to get the best advice that you can get. You spend so many years building your business, and we've seen it time and time again where either the business structure and the legal structure wasn't set up from the outset, the transaction type was poorly put together, and the contract was poorly structured, or the tax advice was wrong. And the only person it makes a difference to, and it really matters to, is yourself as a business owner, because the difference can be in hundreds of thousands of dollars if all these components aren't done correctly. Obviously, this is not tax advice, and I can't give you tax advice, but it's definitely worthwhile getting good at tax advice, speaking to your accountant. And by the same token, we've seen business owners who've had bad accountants giving them bad accounting advice, and the legal structure that was set up 10 years ago wasn't the best structure for today. So that's definitely a conversation you can have ahead of time. And if there's things that needs to be done, like a restructure of the organizations or the entities within your business in terms of what faces the street or the clients, then it's probably a longer kind of process that you want to do sooner rather than leaving it to the last minute. Okay, watertight agreements. So for us, we have a non-disclosure agreement that we send to our clients before they give us any information. So that's something you want to be mindful of in terms of dealing with brokers and starting this process. The other thing you want to ensure that is in place is a really good non-disclosure agreement that your broker uses when disclosing information to prospective purchasers. Okay, 7 things that every strata business owner should be doing, regardless of whether you want to sell or not. And the reason why we've come up with this list is because we've gone through this process many times, and when we get to the sort of the tail end and these things aren't in place, it makes it a lot more difficult. And once again, it's probably better to have these things in place because we never know what might happen. But I'm also mindful that everyone's really busy, and some of these components get a little bit neglected. So these are 7 sort of high-level topics. Obviously, it's not an exhaustive list, but it's definitely 7 things that's worthwhile for, as business owners, to sit down and look at. So firstly, I would say to look at your contracts and look at your clauses. We've had transactions where the manager or the business owner has crossed out XYZ clause in the contract. We've had situations where you might think you have 100 buildings, but actually how many signed contracts do you have? So that's a really good audit to undertake. Secondly, CPIs and renewals. I think that's a really good area to go through and look at, because it can be quite surprising that there's a lot of managers out there who haven't put through the CPI increases over the years. Thirdly, your pipeline. Is it an actual pipeline you have collated somewhere, or is it just something arbitrary in terms of a list of people that you have in your phone? I think, a good broker, I think the conversation should be about sitting down and putting a value to your pipeline. If you have developer contact, if you have new buildings that are likely to come in to the business in the next 12 months. So putting together your pipeline, I think that's really quite important. liabilities and obligations. So reviewing those components, you'll be surprised we've had business entities where there's a PPSR charge that hasn't been removed from 10 years ago. We've had, you'll be surprised to know, all those sort of obligations of a personal nature. I think over time, you should move towards clearing those if the objective is a sale at some point. Is there value in your fixed asset register? So strata businesses, they're not, manufacturing, printing businesses where you have significant equipment and assets worth millions of dollars. But, you might still have a lot of value in terms of your computers, office furniture, depending on how new they are, when you've bought them. So that's a really good question to ask. Is there value in terms of your fixed assets to a prospective purchaser? Financials and records. I think that's something that a lot of owners probably sometimes get a little bit behind or a little bit complacent on. So I think having good financials and records, I think for your clients in terms of client records and in terms of for the business. And then we've got, lastly, to have a conversation with your accountant. And that's all the things we talked about earlier in terms of legal structures, tax structures. One of the questions we get asked a lot is, what is the demand and what does the market look like? I think if we take a step back, strata is an incredibly resilient industry. You have zero counterparty risk in terms of owners corporations paying your fees. You have growth opportunities in terms of population growth, urbanization, and urban density. You have contracts that are sort of fairly long-term. And in some states, I'm aware that, the contracts aren't as long as they once were with the legislative updates, but they're still, relatively speaking, really good 10 years in terms of contracts. And then you have a wonderful model where effectively the cash flows are positive because most strata management contracts, the management fees are taken 1 month, 3 months, or 6 months in advance. So the demand is really strong across the board. I'm talking nationally, I'm talking small to large businesses. The other factor that's sort of driving the market is really strong competition in terms of acquirers and different entrants. So there's a lot of new entrants at the top end that you may not be aware of. So these are sources of funding from outside of strata, outside of real estate, and other sort of funds looking to invest. And strata is definitely something that's sort of come up on their radar. So I think in terms of market trends, strata industry is attractive. There's really strong demand, there's really strong competition, and there's a lot of entrants, especially for businesses over, I would say, 15,000, 20,000 lots under management. So there's definitely lots of value in your business if you've gotten it to that stage. Okay, so I think, in terms of, the work we've been doing, we've been having conversations with various people across the industry for the last several years, certainly a lot more proactive since we've come out of COVID in Victoria. We have purchasers that probably fall into 3 categories: the ones that are looking for the 1,000 lots under management, the ones that are looking for the 8,000 to 10,000 lots, and the ones looking at the 20,000 lots and above. And really what they're looking for is a foundational and keystone entrant into a particular market. And then they would probably have still acquisition appetite after that to do bolt-on acquisitions and expand from there. Okay, if you think it's expensive to hire a professional, wait till you hire an amateur. So look, I think that's really born out of having conversations or getting the phone calls in the last few months from business owners who are halfway through the process, but they don't trust the process that's occurred. And the article I wrote earlier in terms of the business owner with 1,000 lots under management and the business broker having one offer on the table and being pushed to take that offer, it was concerning to us for 2 reasons. One, there should be a lot more interest in terms of that particular portfolio. And 2, the methodology in terms of the valuation was very haphazard. They've simply taken a top line multiplier, applied it to a component, an arbitrary component of the revenue, and said, this is what we think it's worth, and this is how we're going to market it. So that's something we really want to reinforce in terms of just getting that process right. Okay, so, and lastly, you know, there's my contact details.
I found it really interesting when you were talking about getting your house in order and the 7 things that you had listed down that are really good for any business owner to do. I thought that was very useful. And I guess just knowing the value of your business sounds like it's good business anyway. When selling a strata management business, would a purchaser be more likely to retain the original trading company or establish a new one with no trading history? What's more beneficial?
I think whether you do an asset sale or an equity sale, with both methodologies, for the acquirer to take on your trading name and your logo and your website and your phone number, that can be achieved through both methods. Now, in terms of whether they want to continue the trading name for a period of time or indefinitely, that really very much depends on the purchaser. So you'll have some purchasers or acquirers that want to merge into one brand, and they might do that straight away, or they might be a little bit more strategic by operating it as your brand for a period of 1 or 2 years until the clients are more settled and more comfortable, and then they'll undertake that rebrand. And we've seen that quite a lot. And really what that does is it's beneficial for yourself and it's beneficial for the purchaser in many ways, in the sense that it's less disruptive and it's a lesser change for the clients to digest. The only thing I would say is for the acquirer, it's a little bit more extra work in terms of maintaining 2 brands. So I think it also depends on your brand. I think if you have an established brand with a good reputation, you know, I think the acquirer might look at continuing it if it fits into their methodology in terms of how they face the street. There's national brands that have, national companies or multi-state operations that have multiple brands. So it really just depends.
Which has more financial weight, a building that's been managed for 20 years coming to the end of its contract, or a building with a newly signed 3-year contract?
Yeah, look, I think when you go through these transactions, the acquirers are looking at contracts, because you're transferring one, yes, a relationship, but also the comfort factor is the contract tenures. So a 3-year contract tenure, that's obviously really attractive for any purchaser. The fact that you've managed the client for 20 years, that's probably goes back to the report card analogy. That's a qualitative factor in your favor because it shows that you have that longevity and there's some build up goodwill. So both are important, but in terms of hard evaluations, the contract tenure, I think, is probably a little bit more important than the 20 years.
How long would you recommend in lead up time to sell your business? 12 to 18 months?
That's a great question. Look, I think if you have everything in order, you've gone through that 7 items on our little checklist, which is not exhaustive by any means, but if you have your house in order, your records in order, your contracts in order, systems, processes, documentations, everything in order, then I think you don't need as much of a runway or time frame, because you can, you know, start the conversation 5-6 months before you want to sell or exit. I think if you were in a position where there's a lot of work to do, then you probably want to start it 18 months prior, because, you know, we've had conversations or people come to us. We've sat down with them and it's been a bit of an eye-opener because they realize there's a lot of things that weren't in order. So it goes back to what I was talking about earlier with legal entity structures, contracts, CPIs, systems, processes, documentation. So the house wasn't in order, and they had to go back and maybe spend 6-7 months getting things in order before really looking at starting that process there to make an exit.
If it's a franchisor that you're looking to work with, what issues do you see with the processes to work with a franchisor and their requirements to comply with franchise contract?
I think it comes down to the franchise group, looking at what value they bring to the table, the brand recognition, how restrictive they are with their terms, so geographical restrictions and other things. And it's probably, I think, probably worthwhile to obtain some legal advice before you sign that franchise agreement.
Why are business owners choosing to sell?
In my experience, it's always a confluence of factors. It's never sort of one factor in isolation. And if you think about it, it really can't be. Firstly, I think you need to understand the financial component, which is, where you're up to in your life, what are your other opportunities, and can you retire, or are you looking to exit industry and work somewhere else in another space? So that's number one. Two, it's personal factors, and where you're up to and what you're wanting to do. I think we see things like caring for elderly parents, young kids, leaving the nest, those being factors. So I think it's always a confluence of different factors coming together. I think in recent years, I think the COVID and lockdowns have been particularly hard. I think definitely in New South Wales and also particularly in Melbourne and Victoria. So I think coming out of that, there's been a lot of, I guess, more disgruntled clients, a lot more issues for strata managers day to day in terms of dealing with those issues. And that obviously escalates up to the business owners, which can be a factor as well.
If the multiple method of valuation is not appropriate, what is the alternative?
So it's looking at the holistic business, and that's what we do. My background's in external audit, banking, and finance, and I love to pull apart numbers. And I feel it's a little bit full circle for me because when you're in external audit, you're very privileged. You get to come in and see what's under the hood of the car. So I never take it for granted when a business owner invites us into their house and shows us their operations in confidence, because that's really the interesting component. We're looking at everything in holistic view. We're looking at the quantitative aspects, the qualitative aspects, the operational aspects, the manpower, the business operation. So there's synergies that you might bring or cost savings that you might bring. The question is, do you benefit from that? And then there are synergies or cost savings that a acquirer might bring. And the question is, do you derive any benefit from that? So, in terms of, a very high level, we go through all the documents and we look at add backs, we look at, all those components on the business side, we look at all the components on the acquirer side.
How is the percentage of income sourced from insurance commission treated in the valuation?
I think it's a revenue component, and that's one of the qualitative aspects that the acquirers may look at in more detail in terms of disclosures, in terms of agreements, in terms of all those other components. I think it feeds into your top line revenue, but this is probably one of the areas where there's a contrast, because the banks and the funding companies, they're looking at the insurance as a non-certain income item in their mind. Whereas a business valuation perspective, it's part of your revenue. So there is a value there, but it feeds into your top line. And then we're looking at a holistic business valuation. And I think the interesting component is, we also get a lot of different calls from people we know in the industry who are looking at different portfolios, and they're sort of picking our brains as to, the ins and outs and whether it's a good deal or not. And one of the things that has come out of that was there was another broker that had advised the prospective purchaser that because the strata business wasn't taking any insurance commissions, there was an upside by being able to take the insurance commissions. And there's a whole host of issues with that: contracts, disclosures, and also client expectations. Because if they're not used to having insurance commissions paid to the manager, why would they want that with the new company?
If you could ask governments to make one legislative change in this space, what would it be?
The one recommendation, I would say, it is probably the licensing over time. And then the other thing, I think, as an industry, the management fees need to be going up. And how we achieve that, that's a whole different question. Do you know what I mean? I think the one magical solution, obviously it's a little bit of price fixing, would be if all the state governments said, as an industry, your management fee should be $800 to $1,500. No less, no more. And why do I pick that range? I think if you look at property management as an investor, as a property owner, you're paying the property manager anywhere from $1,500 to $2,000 a year. Why is the strata management industry, should be so low? So I think that's probably a very controversial solution or suggestion, but I'm just throwing it out there because it fixes a lot of things: quality, entrance, and revenue models, and in one hit.
Are more transactions cash, or are there any variations?
Once again, it comes down to the size of the transaction. It comes down to the acquirers. There's definitely different structures, and also I think as a business owner, if you're selling and you have one option on the table, then that's already determined as to what that structure is, whether it's cash or earnouts and whatever else. So I think if, as a business owner, in terms of going through this process, the best thing you can have is options on the table, because that will give you the flexibility in terms of how that deal is structured. And how you go back in terms of having that conversation around what the payout looks like, what the earnout looks like, what the actual structure of the settlement looks like.
Have you come across many sellers willing to do seller financing?
Yeah, vendor financing, absolutely, that happens. And it's probably never quite 100%. I think that's probably more commonplace when it's a business owner selling to the staff. But in terms of two unknown parties and vendor financing, it can happen, but I think the expectation should be 10, 20, 30% if you've got a really good vendor who's willing. And it's also contingent on the vendor's situation as well.
Is there a good time or perhaps a size of a business to sell, a sweet spot?
I don't necessarily think so. I think, I think from my slide earlier, we have a number of interested parties who are ready to buy. Obviously, we need to go through and check the metrics and everything else. These are companies or interested parties that we've had many conversations and discussions with over the last year or two. They're looking to either expand, make entry into different markets, and do various other things, or invest funds or whatever it might be. And I would say that they fall into a few different categories. We have a number of parties that are wanting to get into the industry, sometimes from a parallel industry, by which I mean real estate property management. So they see opportunities for cross-pollination. So there's probably a number of parties that are looking at acquiring 1,000 lots, give or take. Then we have companies that are wanting to acquire the 8 to 10,000 lots, and then we have companies that are looking at over 20,000 lots. And these are pretty serious players looking at investing, and they're looking at entries into different markets. So 20,000 plus lots, that's probably the three categories I would say.
How important is succession planning?
Yeah, look, I think I think probably traditionally the strata industry was definitely very family orientated, and we know there's many businesses across the states that have handed down from within the family. I think that's ultimately that comes down to if that's the right outcome for the parents or for the children, and also whether there's interest there. So, and then we've also seen a few businesses where it's being passed down to a senior staff.
Thank you so much. It's been really enlightening. I've really enjoyed the session. It's something that you don't see discussed very often. So we thank you very much for coming on and explaining the process to us and how it all works. If you gained value from this video, please hit like and subscribe to our YouTube channel. If you're looking for information about parking, strata insurance, defects and more, head over to lookupstrata.com.au or sign up to our free weekly newsletter via the link in the description box below.